Some of you have heard the term house hacking before, and you may believe that you actually know what it consists of. But do you really understand how it works? Have you really looked into it for yourself as an option? For some of you, it may not be right at all. For some of you, it may be the spark that gets you started towards building a multi-million dollar real estate portfolio. In this video, we're going to review the pros, the cons, and the truth about how house hacking really works and whether it's right for you. Welcome back to Confident Real Estate. I'm your host, JC. Typically, when you go to buy your very first investment property, the biggest hurdle to doing so is the money that's required to buy it. Banks, when you go get a traditional mortgage, they want to see you put down 20 to 25%, even 30% of the total purchase price. And they also want to see that you have significant income or savings beyond that to float the mortgage payments should you find yourself in a tight financial situation down the road. That's typically because they know that you're more likely to pay the mortgage on the house you actually live in with your family than you are to pay the mortgage on an investment property that you and your family don't live in. On top of that, because of the subprime mortgage crisis and the Great Recession of 2008, it's nearly impossible to find mortgage insurance for an investment property that's debt leveraged over 80%, meaning you put less than 20% of the purchase price down on the investment property. Banks can't get the insurance to cover that. It's for this reason, as well as maybe a prior bankruptcy, poor credit, or some other financial situation, that many new investors find themselves having to seek alternate financing and creative financing options in order to buy their first investment property. But what if you didn't need to? What if you didn't have to jump through all those extra hoops and get creative and think outside the box and really put yourself in a unique situation in order to buy that first property? What if you could go just get a simple mortgage from a bank, but you didn't need to put 20, 25, or even 30% down on the property? What if you could put down just 5% or less? That would probably be something you'd like, wouldn't it? Then you're definitely going to like this video, which means you should absolutely bang on that like button right now if you haven't done so already, and really please consider hitting subscribe while you're at it because, well, I'd appreciate that. House hacking is the concept of buying a house with extra units or extra space and living in part of the house and renting out the rest of it to other tenants or roommates. Either you buy a duplex, triplex, or quadruplex and you live in one unit and rent out the other 1, 2, or 3 extra units, or you buy a house that's larger than what you actually need to live in and you rent out the extra space and rooms to roommates. The latter of those options is actually a tremendous way to start building wealth, credit, and a real estate portfolio if you're young and you just started working and you have friends that maybe don't have enough money to or good enough credit to go rent their own units and apartments, or they would like to have a roommate that they actually know and like and not live with complete strangers. As we often discuss on this channel, the real keys for success in investing are knowledge and experience, and there really is no better way to gain actual hands-on experience with things like property management than house hacking. The benefits of house hacking are numerous. If you live in a home, even a home with additional apartments, as long as you live there and it's your primary residence, then it qualifies for a home loan. That is the major difference. You're not qualifying for an investment loan on a rental property. It's a primary residence home loan. If the property is your primary residence, then you're going to have a lower mortgage rate, less lender fees at closing, and perhaps even favorable property tax treatment. On top of that, you're going to put down significantly less money than if you were buying an investment property that you didn't live in. Your down payment won't be 20, 25, or 30%. It could be as low as 3 to 5%, depending on the property and your qualifications. These mortgages can be made on single-family residences or homes with 2, 3, or 4 units. Generally, if there's more than 4 units, it's considered a commercial property and it's not eligible for a residential mortgage. But let's say you have poor credit. This is still an option for you because you may be able to qualify for a FHA loan. They're not the quickest or the cheapest, but they will allow you to buy a property with 3.5% down payment, and you can still receive rental income from the other units in this home that's now your primary residence as long as you live in one of the units. But on top of that, if you happen to be a veteran or an active duty of the military, you may be able to obtain what's called a VA mortgage loan. And in that situation, you could potentially buy a multi unit property to live in and rent out for no down payment at all. Let's say you buy a triplex for $300,000. You go live in one unit and you rent out the other two for $950 each, for a total of $1,900 a month in income. If you obtain a conventional mortgage with 5% down at a 4% interest rate, that means you have a monthly mortgage payment of about $1,361. And we'll say that including the escrows for property taxes and insurance, you're paying $1,800 per month total to your mortgage company. Not only does the rent you collect completely cover your mortgage payment, but you're generating an extra $100 in positive cash flow per month in year one. And over time, your tenants are paying down your loan and building your equity for you. Not to mention that you'll probably increase your rental rates as the years go on. To determine if house hacking is right for you, you have to be very honest with yourself and your lender. You have to live in the home as your primary residence. You can't obtain a mortgage telling the bank it's going to be your primary residence and then immediately move out and rent the unit you were supposed to be living in and collect rent on all the units as a full investment rental property. That's mortgage fraud. You don't want to do that. Now, you don't have to live there forever, but there are usually certain time periods that your lender will require you to live there, say 2 years. Make sure you know what those are before you enter into the mortgage, and be clear on that from the get-go. You also need to be prepared to share your space because realize that your tenants are your neighbors. Also realize that this is really an equity appreciation investment for the long term, and it's not a cash flow investment. You're not going to be receiving significant cash flow, and you're probably going to have to come out of pocket for any major maintenance expenses, as well as paying a portion of your mortgage to your lender if you have vacancies and tenant turnover. On that note, be advised that the banks will want to see that you have the ability to afford the entire property on your own, meaning they are not going to calculate the potential rental income from the additional units as part of the overall calculation to determine whether you should be getting this mortgage. If you don't have the ability to support the entire property without any rental income, you're probably not going to qualify. They're going to look at your income, your credit, and your debts to determine whether you can actually afford this property. It's for these reasons that house hacking may not be right for you. It's definitely not for everyone, but it is a tremendous way to buy a decent property for very little cash investment and to build your net worth, which you could later leverage to build an extensive cash flowing real estate portfolio. Really take a look at it and weigh the pros and the cons and determine if house hacking is right for you. As always, I hope you got something out of this video and that we were able to elaborate on something you may have heard about, but maybe didn't know all the ins and outs of. Please, if you haven't already, please hit like on this video, consider subscribing, we'd really appreciate it, and leave a comment down below if there's something you want to know about this video that we didn't cover, or if there's a topic you'd like to see us cover in a future video. Once again, I appreciate it. Until next time.